Hi there, my name is Stephen Walker. I'm Managing Director at Fortis Accountancy Services, and this is a quick video about the changes that are being made to the way in which dividends are taxed within the 2016 to 17 tax year. This video is going to be aimed predominantly at my target client base, to be honest with you. It's going to be aimed at small to medium-sized businesses and people who operate as a limited company with a combination of a minimum salary and the rest being dividends. So let's quickly recap the way in which dividends used to be taxed. It was basically the case that you could receive dividends within your basic rate tax band, which is about up to £43,000, effectively tax-free. Now actually that isn't true entirely, because in order to pay dividends, your limited company needs to have taxable profits in which to pay the dividends from. And corporation tax therefore has to be paid on dividends at 20%. So you could receive dividends tax-free within your personal tax return. You wouldn't owe any personal tax on them, but your company would have to pay the 20% corporation tax on any dividends that it would pay to yourself. So if we take the example of you receiving £43,000 of dividends from your limited company, under the old rules, you could receive those dividends tax-free within your personal tax return, so you wouldn't owe any personal tax on them. However, your limited company would have to pay 20% corporation tax on those dividends, and that would be £8,600 of tax that the company would have to pay. Under the new dividend rules, however, you would also have to pay £2,025 in personal tax on that amount of dividends, £43,000. And the company would also have to pay the £8,600 as well. So if you, for argument's sake, just to keep things simplistic, extracted that amount every single year, your tax bill is going to increase by £2,025. Now, in a more general sense, this tax change is basically going to increase personal tax for the majority of people who extract dividends within the basic rate tax band and the higher rate tax bands as well. It really only benefits somebody who has got their income as mainly being salary and has only got a little bit of dividend income. If you are somebody who is a small business, if you're somebody who operates as a limited company, whoever you are, and you extract your income and there's a combination of minimum salary and the rest being dividends, it's more than likely that your tax bill as a result of this change will increase. Actually, I have been very generic in the video so far. I've not explored exactly how it's changing, and to be honest, if you have got a salary of, let's say, £9,000 and you've then only got like a few £1,000s worth of dividends, you won't be paying any tax. So basically, you do have your personal allowance, which is what you'll earn tax-free, which is £11,000 for the current tax year. Now, as well as that, one thing this change does bring, which is a good thing, is a dividend allowance of £5,000. So effectively, you could receive up to £16,000 without paying any tax on your dividends. However, what the change does bring is a new tax rate for basic rate dividends after that amount of 7.5%. Under the old regime, the effective tax rate was 0%. Again, we can go on the mechanics of actually the tax rate in the old regime was 10%, but you got a 10% tax credit, but effectively you could receive dividends within your basic rate band and not pay any tax. This change, unfortunately, does bring a tax liability for many people. Okay, so I just want to stress again that we have been very generic in the video, and for some clients the tax bills won't increase, but I do feel that for the majority of small businesses throughout the UK, they will experience a tax increase of some sort, and I feel that a lot of accountants after the 5th of April are going to have clients who are going to be not entirely happy with the tax return. So if you are one of those clients and you have tried to search out what your accountant has said, believe me that this change has happened and unfortunately is resulting in high tax bills. On a slightly different note, I do have to comment that I do find it bizarre that this change has been made in the first place. I feel that one of the benefits of a limited company is that you are rewarded for taking an investment or risk within yourself. And I feel that the tax system, the way it's been set up, has reflected that the risk you put in is rewarded by a decreased tax regime. Now, I'm not saying it hasn't been abused by a lot of people, but that to me is a separate matter. Whether people operate as a limited company when they should be self-employed, or they should be not self-employed, but they should be employed, there is legislation out there to actually have this dealt with, IR35 is one of them, to penalise every taxpayer who operates as a limited company. I just find that very bizarre, and to me it goes against the whole point of, well, one of the strongest points of a limited company, which is to provide tax incentives. There are still very, very many benefits of limited companies. You've got legal protection. The dividends that you extract from a limited company are exempt from national insurance. So there are still many, many positives to be had from limited companies, but I just think that this change unfairly penalises the smaller business, in my opinion, and I think it's one change among many that unfortunately is making it less attractive to operate as a limited company. I hope you found the video useful. We'll put more description and more meat on the bone on our website with the blog, and if you've got any questions, please feel free to get in touch at any time. Thank you.